more than 80% of the loan to value, right? You always want to make sure that the individual or the entity has at least 20% equity in the property. Again, because in a situation where if they're defaulting and you need to sell the property, you want to make sure, depending on where prices are, that you can get your money out, right?
Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, as always, Christian D. Evans. And guys, this next guest is a real estate investor, an entrepreneur with a passion for commercial real estate and financing. Within 3 years, this man scaled a boutique real estate investment company for $1.5 million to $20 million assets under management and grew his own personal real estate portfolio by 200%. So you think you should listen to this podcast? You bet your ass you should. Now, he's also passionate about helping people achieve their real estate goals to create passive income and freedom. He recently developed a course on private lending, which we're going to be unpacking a lot on the strategies, the tactics, which teaches people how to earn passive income by offering secured private mortgages to borrowers who need private financing. His prior experience spans a multitude of industries, including automotive, healthcare, and technology, with a focus on mergers and acquisitions and scaling organizations. As most notably, he played an integral part in the growth of Amenity Health Care Inc, a consolidator of the independent pharmacies that was acquired by private equity firm Quest Partners in September 2017. Please welcome my next guest, the one and only Rory Bloomfield. How you doing today, my man?
Doing great, Christian. Thanks for inviting me. I've been looking forward to this conversation.
Well, man, I am looking forward to this conversation as well. And one of the things, obviously one of the reasons why I want to have you on is we're going to be talking about lending, financing, and kind of those tactics and strategies and so forth. But, coming from $1.5 million to $20 million AUM in a very short period of time frame, that's very, very impressive. Let's kind of start with there. What got you into real estate, and obviously what helped with that massive growth?
Yeah, to be honest, I kind of actually just stumbled into real estate. It was interesting. I had experience in raising capital, private capital. And when you think about how to scale a real estate portfolio, it's obviously very financing driven. So the boutique company that I joined at the time, they were very early on. They only had about 1.5 million assets under management, only 2 buildings. And, I guess they really kind of saw my experience in terms of financing and how that would apply to being able to scale our real estate portfolio. So I joined them in 2019, and it was interesting because not that long after we hit COVID, right? And I think what was really interesting about that time is we actually ended up scaling our growth about 3x throughout the pandemic, whereas a lot of companies and institutions were scaling back. So a lot of it as well was actually through private lending, which we can get into. But I came on board, and I think it was just about finding the right deals, the right financial backers. And while a lot of people were pulling back at that time, we were really being more aggressive through the pandemic.
Why do you feel like you were being aggressive? Because like you mentioned, at a macro side, we're even seeing this right now in other industries. A lot of people are sitting on the sidelines, just sitting on dry powder. So, and I love people like yourself that are aggressive while blood is in the streets, right? That whole concept. So what were some key performance indicators and metrics were you looking and relying on, even when you saw the macro uncertainty in the environment, be like, hey, let's take advantage of it? What was that perspective or paradigm or that mindset? Where did that come from?
Yeah, I think for us it was just about finding the right deals, the right opportunities, right? I mean, even though there was uncertainty in the economy and people didn't know what was going to happen, and it was a risky time. I think really for us it was about identifying the right deal, the right opportunity, because ultimately at the end of the day, if a building or a property is cash flowing and you've got the occupancy, even as interest rates rise, as long as you've got that occupancy and that cash flow, and again, people were scaling back. There were a lot of deals to be had because people were looking to unload their properties. So we were focused more on the actual deal rather than sort of what was going on in the macro economy.
So I'd like to dive into that before we dive into lender financing. When you're looking at the deal, specifically, help us understand what industry were you said commercial, but in that commercial space, there's tons of different verticals within
Yeah.
that commercial space. Dive into that, and then also you and I know definitely in the office space commercial side, it took a hit. And it's still taking a hit in regards to kind of acquisition. Some people are selling that stuff pennies on the dollar because they just can't get rid of it because of just everybody's going on webinar and online and so forth and work from home. My point is what did you look at in regards to your KPIs, those deals that said, okay, hey, this is aligned with our thesis. We know that obviously we're going to be productive and profitable. What did that look like?
Yeah. So the thing for us at the time was the majority of our portfolio was focused on multifamily, so apartment units. And what's interesting is that multifamily real estate remained the strongest asset class in real estate, both through the 2008 crash and recently what happened with the pandemic. And that's how we sort of had that level of assurance, because people always need a place to live, right? Businesses don't always necessarily need a place to locate, but people always need a place to live. So I think our portfolio was about 90% multifamily. And when you talk about, KPIs, metrics, what were we looking for? That's how we were able to mitigate our risk as we expanded, because we were much more heavily focused on the multifamily side of the equation. In fact, as interest rates continue to go up, it becomes more unaffordable for individuals to be able to buy properties, which means that now they're forced to rent. So oftentimes what's happening when rates are going up is that there's higher demand for rental properties. And, that's why it was a great time for us to continue to expand, particularly on the multifamily side of things.
That makes sense. And let me ask you in regards to when you're looking at the deal, did you anticipate maybe a relatively okay vacancy rate, but also you have to anticipate cash flow is kind of depleted, mainly because of the moratoriums, because of these other kind of government things that were happening, a lot of pauses on rents, housing, they pushed that out, et cetera, on regards to payments. So we saw a lot of that stuff that obviously real estate investors could not control. And that was, give and take. We could look at that now, hindsight and say, well, that was a good or bad situation. But the reality was, it is what it is. So, when you were looking at the deal, did you anticipate that, in regards to your metrics and as well as regards to like, hey, we anticipate maybe a 30% loss on cash flow because of these government situations?
Yeah, I think, look, you always want to make sure you've got backstops, right? I mean, especially when people are not paying rent. And what was happening, at least here in Canada, was the landlord and tenant boards were getting very backed up. So it got increasingly more difficult to deal with tenant issues. So I think it's something that you always want to factor in. This is why I love multifamily, is because if you've got a large building and you've got a couple tenants that are not paying, sure, it's going to impact your cash flow, but it's not like you've got a single family home where if someone's not paying or leaves, you've got 100% vacancy, right? So I think we definitely took that into account. Obviously, as interest rates rise, cash flow, depletes a little bit. But I think it's just about sort of having that level of scale as well, where if you've got some tenants that are not paying, that you've got a whole bunch of other tenants that are going to help you sort of weather that storm. And with us, we didn't really have that many non-paying tenants throughout COVID. So maybe we got a little bit lucky as well. But I think it's just about, understanding your occupancy rate. And, I think in commercial real estate, most important metric is number of units. So that certainly helped us sort of mitigate our risk as we continue to scale.
Interesting. So you found that there was a relationship to number of units, and then you could anticipate maybe a percentage of those individuals that were non-paying, but that would offset obviously still all the units that were paying. So then maybe your cash flow took maybe a small percentage hit, but it wasn't effective and it didn't hit too much the bottom line.
Exactly.
Okay, that's cool. Did you like anticipate like a 3% or 4% non-payment of renters or units, or what did that look like? What was this comfortable kind of margin, if you will?
Yeah, so I think, it's particularly through COVID, obviously we were always sort of anticipating the worst, right? Like I think you really want to make sure you're planning for the worst. So our typical planned vacancy under normal circumstances, probably around 5-6%. Throughout COVID, we were probably at least doubling that. But again, in a building where you've got 30-40 units, even 10% vacancy is not the end of the world at the end of the day.
And even when you're structuring these deals, did you come in with more cash to offset, potential cash flow depletion and less debt in regards to kind of the deal as well?
Yeah, absolutely. And that's definitely important is, particularly when you're going through a time like that, the amount you're leveraging yourself is obviously key, because if you got a lot of debt on the books, now interest rates are rising. Now tenants are not paying, right? That's when you're getting into a bit of a sticky situation. And that's where a lot of people run into trouble, where they've over leveraged. Let's say the economy was great, they were over leveraging because there were no issues. Now all of a sudden we hit a recession, there's a ton of debt on the books, interest rates go up, people stop paying. That's where you can get caught between your legs. So we were definitely putting down a little bit more in terms of what our loan to value was as we were closing these deals.
Well, see, that's why I wanted to bring this up, because I've seen this time in and time out, definitely 2008, and I was younger then, but now you're looking at the kind of the same cycles, if you will, where interest rates, you lock in something, wow, that's amazing, but you take out a loan that's just ridiculous, and 90% kind of whatever, and that's fine, but the reality is you have to anticipate, well, if you have a vacancy rate of it drops down to 90%. Well, what does that happen to your cash flow? How does that affect your, all this stuff? And then what if it, in worst case scenario, it drops down to 85%, or, some individuals don't pay, and, and that's the reality of circumstance, and anticipating, kind of creating those plans of, hey, what's the worst case scenario, and can we still provide and create cash flow and keep the business and asset under our books, even with the worst case scenario. And so I appreciate you kind of explaining that, how you came in. It wasn't just like you went aggressive. You came in very strategically, very effectively in your approach to make sure that, hey, you could weather all the storms, correct?
Absolutely, yeah. And again, it's key to ensure that you're not over leveraging yourself, especially when you're scaling to that extent.
What in regards to that, was there like a comfortable kind of metric when you're looking at, like, let's take a 40 unit, okay, something that's worth maybe $3 million, maybe another example that you could share, and then kind of debt to income, capital, how much you raise to obviously, allocating towards debt. What did that look like to make sure that, okay, hey, this is a comfortable deal structure?
For sure. So I think, first of all, it depends on how you're financing it, right? So, really there's two main methods. Either you're going to the bank or you're going private, right? And so if you're going to a bank, particularly with commercial real estate, generally they're going to fund, say, up to a maximum of about 70% loan to value. I think a general rule of thumb in whether it's a single family home, multifamily, I think kind of the sweet spot is you never want to be more than about 80% loan to value. In other words, you always want to make sure you're putting at least 20% down in an ideal world. That doesn't mean we didn't have scenarios where we were leveraged more to, say, 85-90%. But I would say if rule of thumb, I would say you want to be putting down at least generally 20% to ensure that you're not getting caught down the road. So bank on commercial, they're going to require you to put down at least 35% loan to value. Private is a whole nother world, because that's not regulated by the banks, and that's just you getting financing from another individual or a non-banking institution. So yeah, I put down 65-70%, and then as far as, okay, how do you make up the difference? There's a number of ways. Either the company puts in their own equity, you go to you syndicate with other investors to say, hey, why don't you co-invest alongside us? You put in the 30%, we're going to get the bank financing. You'll be a passive investor. We'll manage everything. Here are the returns we're expecting. So, and that's the thing. I think a lot of people are maybe not privy to is how creative you can get when it comes to financing real estate, even if the bank is providing you a loan. It doesn't mean that you have to be the only individual or company to come up with that 20 or 30%. There's a lot of other ways to supplement that, to leverage other people's money to be able to achieve that level of scale down the road.
That makes sense. That makes sense, and that's why I appreciate kind of unpacking that and how you evolved into it. When you were looking here in the United States, we had valuations of real estate just skyrocket, and so yeah, you're getting a pretty good interest rate, but maybe you're spending more than 30, 40,000 or 100,000 over the actual asking price just to make a bid and get it accepted. Right? We saw that real time, and that was just in the residential. We didn't see that. I mean, we saw that same thing in multifamily and those kind of prices. My point is were you, when you were looking at your deal flow and structuring the deal, were you gravitating more toward like the value add kind of real estate, or what? How did you look at that in regards to saying, hey, this aligns with our thesis, and making sure you're not spending 2 times over the asking price, and making sure that you obviously making some good returns on it?
Yeah, it's a great point and a great question, and that's why even though I own single family homes myself, I still gravitate more towards commercial. And the reason sort of relates to what you're talking about, which is, with commercial real estate, you can sort of control the valuation, right? They refer to it as forced appreciation, and that comes largely through value add. So our philosophy was entirely, we were value add investors. So anytime we were looking at a deal, it was, generally speaking, we were buying existing buildings that required predominantly cosmetic upgrades, right? So coming in, renovating, cleaning things up, increasing the rents, it's obviously pretty standard strategy. So that's, to ensure that we weren't getting caught as prices continue to rise, it was, okay, is there actually room to increase the net operating income? Right? Because in commercial real estate, value is driven by your net operating income, depending on what the capitalization rate is for the area. Single family homes are all driven by, okay, what did your neighbor sell his place for? And that's where you get a lot more caught when, home prices are sky high, you buy at the peak and then prices drop and you can't control the value that you can bring to the asset.
So when you were looking at these deals, and man, that's a really good analysis of it. Would you put like reserves about 10-15% of whatever you raised, or even lending to deploy toward a capex, expenditures on the back end? What was that look like in regards to reservations for capex specifically?
Yeah, so we would do this analysis. This analysis would always be done prior to even putting in the offer or pulling the trigger, where we would just look at, okay, how many units, what do we think roughly it's going to cost per unit to bring it to the level that we want? What in turn is that going to allow us to charge? And then based on that lift in net operating income, depending on the cap rate, where do we think the future value is going to be of the building, right? I mean, it's very much a financial engineering exercise. So that's the model we always ran for anything that we ever moved on the commercial side of things.
That makes perfect sense. Yeah, because I've seen a lot of like slide decks and syndication, and how they analyze that at a very micro level on each unit per unit, and really being able to say, hey, we're going to anticipate spending $70,000-$80,000 per unit, which equals times 300, 400 units, whatever it is, equals this is how much, and so forth. So I appreciate you explaining that. I want to talk a little bit about lending, private lending. You've obviously loved this. You are very good at doing this. And what was that evolution? How did you get involved with it? And let's kind of dive into that a little bit.
Yeah, definitely passionate about the private lending. It's interesting because obviously I'm a big advocate of buying real estate, owning real estate, being a landlord, having rental properties. But I think there's a huge opportunity for individuals that are looking to generate substantial passive income, but maybe don't want the headaches of being a landlord, right? I mean, it comes with a whole different level of of responsibility. So it was interesting when I got into real estate, back in 2019 and started scaling this company. We were acquiring a lot of properties by securing private lending financing. And to be honest, I didn't really know much about it prior to. And what was interesting is that, private lending allows individuals to very quickly close on a piece of real estate, right? You're not, banks, especially these days, especially with how much they've pulled back because of COVID, the amount of red tape it's through the roof now, right? I mean, in some instances with commercial, it can take you 2-3 months with a bank now. And that's what we were finding is we came across great deals, but a lot of the times they needed quick closings. So it unpacked this entire world of private lending where we would go to a private lender, and in some instances we could close on a commercial deal within 2 weeks. Yeah, so very, very interesting. And I think there's the private lending side in terms of acquiring and needing financing, but then there's a flip side of individuals that are looking to generate passive income but don't want to be a landlord, where they can actually provide private mortgages to individuals or companies that are looking to acquire. And sort of what I've said and what I truly believe is I think, doing secured private lending against real estate is one of the most lucrative ways to generate passive income relative to the level of security that it offers, right? Because by providing a private mortgage, you have the asset. So in the event that someone cannot make payments, although this is not the objective, you can either foreclose or push them into power of sale. So to be able to generate 12, 14, 15% interest a year while having the security of an asset, certainly I don't think the stock market is going to give you that return with that level of security. So very, very compelling offering.
Look, the way it's structured, correct me if I'm wrong, is it is a very cash flow situation. So the investor or the private lender, you have to have a lot of cash to be able to say, hey, here's 50,000, 100,000, 500,000, whatever it is for that property. And then we structure that out on a loan term. And that could be basically through you and the individual negotiated, and as well as the interest rates term, and then how much you guys expect. And correct me if I'm wrong, but that's kind of the structure of it. Now, when you're looking at underwriting that individual, do you underwrite that individual for their real estate portfolio, or do you really underwrite the actual asset, that real estate that you're actually lending the money on, or is it kind of both?
Yeah, it's definitely both, and I talk a lot about this in the course I developed, where you want to take both into account, right? So obviously you want to know who you're lending to, right? I mean, no matter how good the deal is, you don't want to lend to you want to do a background check, right? You don't want to be lending to someone who is fraudulent or anything of that nature. You want to make sure they're in good financial standing. Like basically you are requesting a personal statement of affairs of the individual that you're lending to, which gives their entire financial breakdown. So you obviously want to take that into account, especially in the event that maybe things go south. You can never have too many assurances, but obviously the deal that you're lending on is equally important. And, we were talking earlier in the conversation about being over leveraged and getting caught, between your feet. You want to make sure that you're not lending on a property that's overly leveraged as well, because that's when the borrower risks, there's risk of default in that case on your payments.
Let's unpack this a little bit. So when you're underwriting, what are you looking for? And I know it's really dependent upon what vertical you're in, right? I definitely understand that's very contextual, but let's kind of take a 30,000 foot view in regards to like what you're looking for in regards to that individual that's asking for the lending amount, as well as the asset you're actually underwriting. So let's kind of talk about your thesis. What do you gravitate toward? Are you more single family investor? Or are you more of like multifamily as well? Because that's kind of what your niche is. When you're, private lending, what niche or what investment thesis do you focus on, and what does that underwriting process look like?
Yeah, I mean, I think private lending on both, there's opportunities for both single family home and multifamily from a private lending perspective. I wouldn't necessarily say to someone only do one, but don't do the other. And keep in mind, just like you said, you do need some cash to be able to do private lending. For single family homes, you're not going to need as much as commercial, right? Just inherently, the price of commercial is going to be much higher. I would say, generally speaking, and we talked about this a little bit earlier, I would sort of tell people, do not lend more than 80% of the loan to value, right? You always want to make sure that the individual or the entity has at least 20% equity in the property. Again, because in a situation where if they're defaulting and you need to sell the property, you want to make sure, depending on where prices are, that you can get your money out, right? It's all about, how can I ensure that I can get my money out in a worst case scenario? So loan to value, equity, that's a huge factor. Obviously, what is the cash flow, the monthly cash flow of the property producing, right? You got to make sure that the borrower can service your interest payments on a monthly basis. And then one thing that's very important too is the exit. As a private lender, how am I going to get my money out in a year, right? I'm not a bank where I'm going to finance you for the next 25 years. So how am I going to get my money out? Is the individual going to pay me out of his or her own pocket? Are they going to find another private lender? Are they going to go to the bank and refinance? So you at least want to have some sort of an idea of how you're going to be able to get your money back when the term expires.
And you mentioned 1 year. Do you, extend that out to 4 or 5 years? Because like you mentioned, at the end of the day, I mean, if you're having a 7, 8, or even above, prime mark annual rate, then you're actually doing pretty good in regards to passive income. So if it's like, averaging 8, 9% or something like that, and maybe they can't go to the bank because they need to close in a short period of time, and they're fine with paying extra interest rate, and say, hey, well, I can, leverage this out for 5, 7, 10, maybe 11 years. You get compensated as the investor. And like you mentioned, it's kind of hands-off approach, as long as your underwriting is dialed in and your investment thesis and so forth. But do you as a specifically private lender, do you like to stick with a 12-month kind of term, or do you like to extend that out? What is your kind of comfortable?
So I think it depends on the individual and the lender, right? Some people don't want to be hassled with having to go through the process again of relending. And if the borrower wants to extend, then a lot of people will say, great, you know what? Let's just let it continue to ride. If it were me personally, one of the other great things about private lending is that aside from the interest, lenders are charging upfront lending fees as part of closing a deal. So generally, when you're lending to someone on closing, you can charge, rule of thumb, I would say, around 2 or 3% of the value of the loan that you're offering. So let's just use round numbers. Let's say you're giving someone $1 million private mortgage. When you close, you're going to get a check upfront immediately for at least $20,000. That doesn't include the monthly interest payments that you're getting on the loan. So my point is that for me, my objective would be, how many times can I recycle my money, let's say, in the shortest period of time? Because every time you orchestrate a new private lend, you're also charging that upfront lending fee, right? And the other potential disadvantage of continuing to extend is that it may not necessarily give the opportunity to increase your interest rate as well, depending on where things are at. Interest rates with private lend generally will go up or down depending on bank rates. So right now, because as interest rates with the bank continue to rise, on a first private mortgage, at least here in Canada, you can charge easily 10, 11, 12% for a first mortgage, not including your lending fee. So now if you're adding another 2% onto that, you're talking about banking 12 to 14% total for the year, which is pretty good.
Okay, I'm so glad you explained that in regards to like some red flags. The reason why you don't want to extend this out to 2 or 3 or 4 years, because like you mentioned, the interest rate right now we're seeing, like you just said, increasing, and you want to kind of adjust the term according to whatever the interest rate. So if it goes up to 8%, the bank rate, then obviously you don't want to have an 8%. You want to maybe add another 2 or 3% on top of it with your individual, and have that conversation, that dialogue, which I definitely understand. When you're looking at these conversations with these individuals, the people that are looking to deploy that capital toward it,
Yeah.
and you're having that conversation, what are some red flags or green flags or things you should be aware of when you're having a conversation, you're having the dialogue, but also like just the deal negotiation, making sure that everything's dialed in. Maybe certain things that you've done before that were like, oh, I learned from that, and obviously adjust next time and optimize next time when you deploy capital in the private lending space.
Hmm. Yeah, again, I think it's a lot of what it comes down to is risk mitigation, right? As a private lender, how do I ensure that I am mitigating my risk in the best possible manner? And I think really we sort of touched on it, but I think it comes down to two things. Obviously, number one, who are you lending to? What is their history? What's their personal net worth, their assets, their capacity to service the loan, and then I think obviously equally as much the asset that you're lending against. So just for an example, to get a little bit more granular, I would say you always want to make sure that you're getting an appraisal on the property that you're lending against, right? Because again, you want to make sure that the loan to value, what the property's worth relative to how much you're lending, you want to make sure that that's in line, so that the borrower is not overextending themselves, so that if the property needs to be liquidated, you have assurances that there's a healthy buffer there of at least 20-25%. You're going to be able to get your money back as a lender. So I think it's not really that subjective. Like there's a couple key criteria that you want to look at to say, okay, does this deal make sense? Is it a good deal to lend on? And you can very quickly sort of grow a private lending business easily, where you're just constantly loaning out, recycling your funds, collecting lending fees, collecting interest. It can scale pretty quickly.
Well, let's kind of unpack that scalability a little bit. What does that look like? What are certain strategies that you're looking at in regards to your own private lending business to help scale that? So for some individuals, a lot of our audience, they run a pretty decent sized business. They're taking dividends from their company or a salary or whatever it is. And they've got some other wealth kind of strategies in regards to secondaries or alternative investing or private equity or VC or whatever it is. And they're obviously looking at this private lending, like you mentioned, the risk reward is pretty good, right? As long as you structure it accordingly. And some of these individuals have some cash.
Yeah.
And so what does that scalability look like? Because everybody in today's world, they want to scale. What's that strategy? What does that look like? So what are your things are you doing right now to line up that foundation to be able to obviously scale to that next level?
Yeah, and again, I think a lot of it comes down to how much capital are you starting with, right? I mean, the more capital you have, the quicker you can scale. And so I think, generally speaking, I guess the way I would look at it is, okay, of my total portfolio, how much do I want to allocate to something like private lending? And from that point, it's okay, what is the amount I'm working with? And is that enough to lend on one property? Is that enough to lend on two properties? Because again, with private lending, if you really want to maximize your ROI, it's all about how quickly can you recycle your funds. Because every time you're recycling, as I mentioned, you're collecting a 2 to 3% lending fee, which is not insignificant. And there's opportunities to raise your interest rate again within reason. So I guess the way I would look at it is how much you have to work with, how much can you recycle your funds. And it's also, and I talk a lot about this in the course as well, being connected to the right individuals. And really I would say folks like real estate agents, obviously mortgage brokers, real estate lawyers, these are the folks that are interfacing with buyers every single day that may need private financing. And I can't tell you how many times I've talked to the main realtor I work with, where he calls me and he says, hey, I have a client that needs $500,000 to close on property X. Do you know anyone? So it's very important to build a network of those individuals who can also funnel you deals on a consistent basis, because obviously in terms of scale, without deal flow, it's going to be tough to achieve that scale.
So let's take an example here. Let's say someone who's listening to our podcast has $1 million in cash or sitting on, and they're looking at obviously deploying it in the private lending space.
Yeah.
And you mentioned this, do you believe, and obviously you want to underwrite the individual as well as the asset itself, and that comes with it without saying, but do you believe in like deploying $250,000 in 4 different deals and structure that way? Because then you can obviously allocate maybe interest rates on each one, and then you get a better kind of return. And then after 12 months, obviously there's some sort of exit, and there's some, you get paid, compensated, not only on the front end, but the back end. And then you're able to kind of, now you compound that money, hopefully, right? And you're able to then take that and then deploy that out. Now that $1 million turns into maybe, let's say, conservatively 1.5, right? Now all of a sudden 1.5, now all of a sudden you can do that again, and now you're pushing that out. Is that kind of how the scalability aspect works?
Yeah, so it depends, and I guess to dive a little bit further here, there's opportunities to deploy capital on a first mortgage, but there's also opportunities to deploy capital on a second mortgage. And so really, when you're talking about $250,000, to be able to find a buyer who is looking for a first mortgage that only requires $250,000, especially in this day and age, there's not the amount of the volume of real estate out there that's available for $250,000 is it's not abundant necessarily. So it's when you talk about splitting up $1 million, it's relative to the deals that are available and what capital is required to fund those deals. First mortgage is generally going to require more capital, because that's the first party that a buyer goes to fund a single family home. Let's say they're buying a $500,000 house, but then there's individuals that also need second mortgages for whatever reason, and that's when there's opportunity to deploy smaller amounts, because they've already got someone in that first position who's maybe funded the majority of their purchase, but they need some supplemental income. And now what's interesting about providing a second mortgage is because the level of risk is a little bit higher, because you're in second position, not first position, you can now charge a higher interest rate. So now instead of charging 14%, I've seen in many instances, lenders in second position are charging 15, 16, 17% to reflect the level of risk associated. So it's kind of tough to say, in a perfect world, divide $1 million by 4. It's also it will depend on the deals that are coming to you and the capital required to be able to fund those deals.
So you're really looking at these investors. They come to different lenders, and maybe this house, maybe I should say multifamily, is worth $5 million, and they go out and get a lot of different $250,000 checks from different lenders, and each one can be, allocate 80% of that $5 million. And then the rest, they put 20% down and then be able to acquire that multifamily real estate. Is that correct? And then also the structure.
I would say syndicating mortgages is not as common. And I think depending on whether you're in Canada or US, there are some sort of security. I think it is through the 2008 crash, at least here in Canada, they really clamped down on syndicating mortgages.
That's what I was curious on.
In particular. So it's not like you can go get a private mortgage and you've got 25 people that hold that mortgage.
That gave you some money to be able to put it in there.
Yeah, the securities will be all over you. I would say maybe, and again, I'm not a lawyer, I'm not a securities lawyer, but I would say, maybe three, 4 individuals you could probably get away with on having a secured first mortgage. But yeah, it's more, it's not like syndicating on real estate investment where you're pooling to buy an asset. You're going to have fewer individuals when it comes to providing a first mortgage, generally speaking.
That makes sense.
Yeah.
I've seen some real estate individuals like, fix and flippers that do take a hard money lend to do
Yeah.
capex on it. So they buy something for relatively inexpensive that's, maybe get a loan on it, whatever, however they structure the deal.
Yeah.
And they come to a hard money lender or a private lender and say, "Hey, I need, $100,000 to put, X amount of stuff in here." What are your thoughts on that? Because that's not really back on the house itself, but that's
No.
just more of $100,000 for capex. What are your thoughts on that?
Yeah, I mean, when you're getting into the unsecured world, you got to be careful, right? I wouldn't necessarily discourage people from doing hard money. I just think in that case, you really, really got to know who you're lending to,
Underwriter, yeah, it's
right?
really important. Yeah.
Again, you're going to make more because of the lack of security, but you don't have as much peace of mind as you do when you've got the security. So, um,
In your opinion, I know this is just speculation for your own opinion, but do you like to gravitate toward that, or is that somewhat entertaining for like the risk reward, or would you just mainly focus on your thesis in regards to secured kind of private lending aspect?
yeah, to be honest, I think if I were thinking about this for me personally, I would be more inclined to get into unsecured. If I think when an individual is at a point where they're not as concerned about losing money, and they're looking to sort of mix up their ROIs, then I think if you're at if you're at that certain point with your personal portfolio, I think it's fine to do a little bit of unsecured. If you're kind of trying to get your feet wet, you don't have a ton of liquid capital to sort of maybe put out there or risk, I would say start off with doing secured lending, and then maybe down the road gravitate towards unsecured.
That makes sense. That makes sense. Now let's kind of gravitate toward the exit. You mentioned this earlier. Obviously, there's different ways of exiting. Are there certain things when you're dealing with the investor? Are there certain things prior to the exit you want to make sure that they got lined in? Maybe having conversations or talks with 4 or 5 months before the actual timeline of the term is finished. You want to make sure that that individual is having conversations with banks so that you can get your money back. So what are certain things maybe in the contract or in the agreement, or certain things that you like to see kind of in a good way, and makes green light? Definitely, definitely if it's 12 months, on the seventh, eighth month, you're seeing, okay, some activity. So there's going to be a clean exit to ensure there's a clean exit for yourself and the investor.
Yeah, absolutely. And I think obviously, depending on whether it's a single family home or multifamily, the strategy is going to be a little bit different, right? Ultimately, someone can tell you something, and whether they deliver it on it or not, you never know. And that's where the security of okay, if someone can't pay you back in a year, and you want your money, you still have that security of being able to, again, not something you want to sort of have to do, but you've got the security to foreclose or push to power of sale. But I think, obviously understanding the individual, you have the conversation, okay, what are the plans 12 months from now to pay me back? You at least, you wouldn't want to lend to someone that says, well, I don't know, I'll just figure it out then, right? I mean, that's not really an ideal sort of business relationship. So I think fundamentally, yeah, what are the plans, number one? And again, I know I've talked about it a lot, but I think it does go back to the loan to value. How much are you lending relative to the value of the property? Because at least, let's say in a single family home, here in Canada, the bank will give you 80% loan to value. So if you're giving someone a private mortgage at 80% or less, and they've got a decent financial profile, at least that there's opportunity for them to go to the bank to attempt to do a refinance on the property, right? With multifamily, okay, what are the plans for the building? And, I would encourage people that are looking to lend on multifamily. Value add is a great sort of asset class to lend on, because if the borrower is doing the work to increase the value of the property, it's going to make it much easier for them to liquidate your mortgage at the end of the term. So I think it's just about understanding, what are the plans, the intricacies of the deal, making sure that there is sufficient equity there to allow the borrower to properly be able to refinance you out of the lend. And yeah, just having those types of conversations.
Okay, so you always have an exit strategy, which to us definitely makes sense. I've talked to a lot of VCs on our platform today as well, and they always say whenever they're deploying capital towards something, they always have an exit kind of conversation as well, and saying, hey, 5 to 7 years, that's kind of our timeline, or whatever that looks like, and making sure that there's some sort of company or individual entity that also acquires that company. So they had that dialogue. So it's really cool that you mentioned that. I'm curious on like worst case scenario, okay? Term comes up. Obviously, do you have an agreement in there that says, hey, you know what, we're able to extend this? There's a grace period of an extra 3 months to make sure that there are certain things that are able to take place at the same interest rate, XYZ, whatever. Or like, obviously, hey, you missed, 2 payments within the last 12 months, maybe 3 payments, which isn't good. I'm going to go ahead and foreclose on this, et cetera, et cetera. Obviously, the biggest part about this, what I think is communication, right? Communicating with your investors, because at the end of the day, you as the investor, you really don't want to, foreclose, because the reason why you lend it is because it doesn't take much of your energy, right?
Exactly.
So, really it's just, I love to help understand like navigating the worst case scenarios, right? Because not everything is going to play out like it plays out, right, for whatever reason. So just having that dialogue and having that conversation, how do you navigate that?
And again, I think you nailed it. It's and I've experienced this quite a bit over the last number of years. I think if a lot of individuals just did the most basic level of communication, that would avoid 95% of the problems, right? So from the perspective of a borrower, if you're not going to be able to make the payment on time, don't wait till the lender, cashes a check and gets the insufficient funds notice from the bank back, and then they come to you and say, what's going on, right? So, I think depending on the lender, there will be flexibility. It's all about communication. If a borrower is going to, miss a payment, be late, that's fine. But I do think it's about communicating, and it's about, making good on the agreement, because at the end of the day, especially from the perspective of the borrower, look, you don't want to piss off your lenders, right? I mean, you want to be able to go back to lenders and say, hey, I've got another deal. Can you finance me for another? Like, those are very key relationships, especially from the perspective of the borrower. And from the perspective of the lender, people are lending because it's hassle-free, right? You close on the deal, and this is the other thing that I love about private lending. You close on the deal. As part of closing, the lawyer gives you post-dated checks for the duration of the term. So literally all you're doing every month as a private lender is you're taking a trip to the bank and you're cashing your check. So the last thing a lender wants is to now have to be bothered with the dynamics of late payments and this and that. So I think it's just like you said, it's just about expectations, communication, being open, and a lender not feeling like they're maybe being taken advantage of at the end of the day.
That makes perfect sense. And it all comes, like you just mentioned, in communication and really having that relationship with those individuals, because you can figure it out as long as it figures out. And like you mentioned, long term, you want to build that relationship. This has been a lot of fun, man. And I want to talk just specifically here, because everything relies, what I've discovered is, it's almost like hiring, right? It's like hire fast, fire fast. Excuse me, hire slow, fire fast. I got that quote wrong. My point is sometimes you have a lot of conversations, a lot of people asking for money. Out of 100, asks, you only maybe deploy capital with two, right? Because you have a strong underwriting process, right? It's the same kind of concept, a very strong hiring process. So you filter out all the negative stuff, all the negative people that don't fit your culture, don't fit your integrity, don't fit your values, don't fit your investment thesis. So I really want to highlight this at the end here of our conversation, mainly because I want to ask, like, what are certain things you see when you're, and just this is your specific stuff, right? So it's actionable. This is what you've noticed. This is what you're kind of gravitated away from. So like, hey, first time investors, right? Or, people that are coming in, hey, do you have a portfolio already? Maybe not. Okay, I'm not going to lend to you, right? That's a hard no right away because you want someone that has some experience. Maybe underwriting the deal as well. Hey, I look for this kind of range mainly because I'm comfortable with it, as well as I know this industry, I know the metrics, so forth and so on. Or maybe even like the region. You're from Canada. Obviously,
Right.
do you gravitate more toward Canada or a specific part of Canada? What are certain things when you're underwriting heavily on these individuals that you're looking for, and it's a hard yes or a hard no in regards to you're going to have a continued relationship with them?
Yeah, and I think you sort of definitely touched on it a little bit. I think really what it comes down to is number one, the deal, and number two, obviously the individual. I sort of like to say there's no shortage of money out there. There's a shortage of good deals, right? In other words, you find a good deal, you'll get the money. I think people perceive it the other way. I think they think it's much easier to find the deal and much harder to find the money. But I actually think it's reverse. I think there's you find a good deal, the money will come. So I think really it's obviously someone that brings a good deal to the table. And when I say good, I mean we've talked about it a little bit, but just in terms of the dynamics of the deal and how you're participating as the investor or the lender. I do think experience obviously does matter. I think it's relative to the deal though, right? So for example, someone that's looking to buy a single family home and rent it out. I mean, to be honest, that's not rocket science, right? Like, I don't think you need an extensive background to be able to operate one single family home rental property. So in that case, I'd probably be looking more at the individual as just them as the person, what they've done throughout their career, just kind of the basic things. Now, if someone comes to me and says, okay, I'm looking to close on a 50 unit multifamily building, then I'm probably going to be a little more specific and say, okay, what's your experience running a 50 unit multifamily building? What's the strategy? Like, tell me, what's the business plan, right? Tell me the business plan, particularly if I'm investing or coming to you as a private lender. So I think it really does depend on the type of deal that's being brought to the table as well.
Yeah, that makes sense. Building a context around it. If it's a larger, obviously, play, a deal, then naturally you say, okay, I'm going to do a little heavier underwriting. And I appreciate you explaining that because I think it's just so important to do the underwriting effectively. I look at it in any industry, car insurance, health insurance, all sorts of. They do a deep underwriting to say, hey, and then they determine the pricing according to obviously, the risk of that profile and so forth. And they have certain questions, and sometimes there are 100 questions, but sometimes because you identify your investment thesis, because that mitigates your risk on the back end. Having those tough exits, right, where you have to foreclose, right, it avoids a lot of that on the back end. So that's why it's like building that kind of SOP or procedure or methodology to ensure that your risk on the back end is relatively low.
Yeah, and I think one last point on that is the underwriting from the perspective of providing a private first mortgage versus the underwriting on, let's say, being an equity partner or an investor in a building, quite a bit different, right? In that regard, private lending's much more cut and dry in terms of what you're looking for and the type of arrangement and how you're going to get your money back. Whereas if you're investing as an equity partner, that's not, now you've got skin in the game, so to say, and it's a much different arrangement in terms of the exit as well.
Definitely, definitely.
Yeah.
Man, this has been a good conversation and unpacking deep level stuff. Really talking about the private lending. We're not talking much about it, definitely in this vertical. So I'm glad we're able to have someone like yourself that loves it, that enjoys it. For those that, listen to this podcast, I want to reach out to you, want to connect with you, want to build a relationship with you, maybe want to get access to some of the content you have out there. Rory, how do they reach out to you, my man?
Yeah, so obviously, you can connect with me on LinkedIn, and then the course is available rorybloomfield.com. So individuals can go there and they'll be able to connect with me through that as well. And I'll have all my information is on there also.
Awesome. And make it easy, guys. Those links are in the description below. So just click on it and be able to connect with him and engage with him and what he's got going on. And if you want to learn more, obviously it's all right down there in the description. Rory, big time. I really appreciate you just bringing your incredible knowledge and your incredible wisdom, definitely in this vertical, talking about it and the love that you have and the value that you're bringing. And Rory, I always love to ask my guests before I let you go fully, if you think about your young self. You're still very young, but you think about even younger, okay? What insecurities did you have to overcome to become the successful Roy Bloomfield that you are now?
Oh, that's a great question. I think a lot of it just has to do with fear of diving in, right? In other words, I always say to myself, I wish I would have gotten into real estate 10 years ago. Well, why didn't I get into real estate 10 years ago? Because a lot of it what's the word I'm looking for? Imposter syndrome, right? You don't know how to do it. You're afraid to get into it. You don't want to dive in. I wish that I was just a little bit more willing to dive in head first 10 years ago, 15 years ago than I am today.
Well said, man. Well said. So now, back then, it's just going out there and doing it and putting the face to it. And so, Roy, I appreciate you being on here big time, man. And guys, that is my friend Rory Bloomfield, excuse me. And that is Journey with Christian Evans podcast. Until next time, be uncommon if you can.
Thanks for